We are going towards some exercises for chapter 14. I have just 3 exercises. And the first one is 14.3a. And if you want to follow along in the textbook, oh, it won't work. The problem is in the textbook, it's on page 548, but I have an algorithmic generation of the numbers. So it won't be exactly the same numbers because I think your homework is that the actual A version. So that's why it said over here, instead of just A, it says algorithm. They gave me some new numbers. So what I'm going to do is just solve the problems. And the first 2 I'm doing are going to algorithmic. And then the third one is just the one straight from the textbook. They work just the same, just have new numbers added. All right, so this says for us to calculate the cost of goods sold under the periodic inventory system. So the reason I want to do that is because I want to make sure that you see that we're still doing the same thing that we talked about earlier, where we take the beginning inventory and we add the purchases to get to goods available for sale. And then that goods available for sale is either still here, which means it's in ending inventory, or it was sold, so it's in cost of goods sold. So the amount of the cost, the total cost that we have invested in inventory for this period is this goods available for sale number. And we're going to work this, the cost of goods sold section of the income statement to show you how that falls with all these changes we've added for merchandising. We had to have the purchases, then we had to have returns and allowances. We had to have the discounts and freight in. Plus on the sales side, we had to have those adjustments too with the sales returns and allowances and different transactions that are related to the sales. But this is just taking the cost of goods sold. So let's see what we can do. This is that wants to prepare cost of goods sold section for Adam's Gift Shop. Here's the account, the amounts we know. Beginning inventory is 26,000, ending purchases, returns and allowances, discounts, and freight in. So we start out, and what we're going to do is take the cost of goods sold section. Is going to start out with the beginning merchandise inventory. So let's just see what we can do. Beginning inventory was 26,000. And then we're going to add the whole section for purchases. So we're going to put a header right here on the next line. No, we're not. That's not a header. They should have given me a purchases section, but they didn't. Sorry. So they're just going to, I'm just going to take my purchases of $80,000, and then I'm going to adjust for what changes from the amount we paid for purchases happen because of returns and allowances or discounts, and then adding in the freight eventually. All right, so if we take the purchases and then we subtract from that any returns and allowances we've had, purchase returns and allowances, we look up here, okay, it's $3,500. And then the discount, same thing. Now that's not the discounts for buying a lot of goods, the trade discounts. That instead this is the cash discounts. They're the ones that are recorded on our books, where the seller gave us a discount for paying early, like under the 210 net 30 and all those. All right, so we have purchase returns and allowances of $3,500 and purchase discounts of $500. Let's make sure I got those right. No, pulled the wrong number. It's not 500, it's 6,400. Sorry about that. Okay, so that we've got $9,900 is the total amount of the reductions in purchases. So we got $80,000 minus 9,900. So what is that? 70,100. That is the net amount of the purchases. And they call it net purchases. That was convenient. Okay, and then we're going to add into it the freight. That's where the $500 comes in. Okay, so now we have the total amount that were bought this year. The cost of the goods purchased, I guess, is what they're calling this. This is just the new adjusted purchases, basically, and it's 80,000 plus minus the 9,900 to bring you to 70,100, and then you add the freight in, and that brings you to 70,600. Okay, now so that's the amount of add-ons to the inventory that we put in. We started out the period with a $26,000 investment in our inventory, and then we added a net cost of $70,600. So our total goods that were available we could have sold is just those combinations. The amount of inventory we had at the beginning plus what we added this period. So we take the 26,000, add it to the 70,006. That brings us to 96,600. Oh, So that's how much is available. Now, we either sold that or we didn't. The only way we know is if they told us one or the other. They have to tell us how much they sold or how much is still in the ending inventory. When it's periodic inventory, they normally tell you what is still in the inventory, and you can subtract out to see what is the cost of the goods sold. So they did. They gave us an ending inventory of $23,000. So we're going to take the goods available and subtract that ending inventory of 23,000 to come up with how much goods is the cost of the goods sold. And that amounted to 73,600. So I think that's right. Just in case I keyed something in crazy, let's do a check work. Hey, it looks perfect. I love green check marks. Wonderful. So that was good. No problem. So let's go to the next one. This was number 5. And it's also an algorithmic generation. This one is where they're trying to get us to think about these unearned revenue items. And so this one says, set up T accounts for cash, unearned revenue, ticket revenue, and ticket revenue. So our source of income is tickets that we're selling. And so post the following 2 transactions in the appropriate accounts using the indicating each transaction by letter. And so what they're doing is that for transaction, the first transaction, we sold 1,100 season tickets at $300 apiece, receiving cash of $330 million. So it wants us to put the letter A there because that's the first entry, 330. Gotta get the right number of zeros. And that we put to, when we first put it in, we're going to put it to unearned revenue for the full amount, because we don't know if we're going to actually earn them all. They're season tickets, so they may not have all expired by the end of our period. So we're going to put them to unearned revenue. Okay, and then at the transaction B, at the end of the period, we need to recognize that 96,000 of ticket revenue has been earned. They could have told you how much was still unearned, or they could tell you how much has now been earned. But either way, we know the part that's still unearned remains in the account called unearned. And the part that is now earned goes to the revenue account. So they said we need to recognize 96,000 as revenue. That means we're going to credit the revenue account for transaction B. And for transaction B, we're going to reduce or debit the unearned revenue account. Remember that unearned revenue account is a liability account. So that by its very nature tells you that it is a credit balance account. So if you're reducing it to shift some of the unearned over to earned, then that means you're going to be debiting the unearned account to move some of the revenue out of there into the actual revenue account. So let me do my check my work, see if it comes out right. Comes out right? Yes, greens everywhere. This is great. So that's all good. So we're moving on. The next one we're going to do is number 13. And this one is a little more involved. So we're going to make some journal entries. This was actually going to include some of these estimated returns, but we're just going to pace through and we're going to get through this. You're going to have one for your homework as well. It's just like it. Might actually be it, or it might be the one just like it, but it works the same way. So what they're doing is they said the partial spreadsheet shown below is taken from the books of Sun State Computer Supply, a business owned by Michelle DeBow. You'd think she was from Louisiana with a name like that, but it's probably not pronounced that way. I just did it. Okay, for the year ended December 31st of 2000, whatever. Sun State is on a periodic inventory system. Determine the adjusting entry by analyzing the difference between the adjusted trial balance and the trial balance. So what they did is they looked at each of these and said, well, which ones are different? Okay, so the first thing they did is they want us to make the journal entries to match what just happened on December 31st. So let's see. They started with the income summary. And so for income summary, they made these entries. So you just watch what I'm doing and you'll see it's going to work out the same way. The first thing they did was they debited income summary and they credited the merchandise inventory account for $82,500. And the way they knew that that was something they wanted to do is they looked at the inventory count, merchandise inventory here, and they saw that 82.5 and said, oh, we have to move that out of there. This was where there is a periodic system. So they're transferring it out of there into income summary as the first step in their closing. So I'm just posting the entry we just made. Okay. Now the next thing they did was they debit merchandise inventory for their ending inventory. And they credit income summary for that amount. And it was 93.5. Crediting income summary for 93.5. Debiting the inventory count. Okay, that's the first two entries. The third entry, they looked at their sales returns and allowances and their customer refunds payable. The change in those two sales returns and allowances went from 15,950 to 18,370. And that's because this is a contra sales account, remember? They debited it for 2420. I'm just doing this part of the entry first this time. Sorry about that. Customer refunds payable also changed by that 2420. And that's because this entry that we're making right here, debit to sales returns and allowances and a credit to customer refunds payable. So they're actually asking you to recreate what happened. If you see the two, you see the beginning trial balance. I mean, you see the original trial balance and you see the adjusted trial balance. So you know these entries, something happened to change them. They had to be in an entry. So you're trying to identify what would the closing entries have been if the change was this amount. So the next thing they did was they debited income summary and they credit estimated returns inventory. And they did, that was for 3520. Income summary took a debit of 3520. And the estimated returns inventory took a credit of 3520. And you see that's just the balance that's in there. When you do yours, you're going to follow the same pattern. You'll make the same entries. You're just going to change the amounts because this is algorithmic. Okay, it just means it just got a new generation, but it's the same process. All right, so that was that entry. Now the next one, we're going to then record the new estimate of returns. And so we're going to credit the income summary account and debit the estimated returns for 4730. So this is the part that I wasn't really emphasizing when I do it, but I just need to get you through this problem so you can see how it works. It's not that it's going to hurt you to understand this. It's just you might not have a lot of use for it in practice because of the computerized systems that are so prevalent. But in any case, we still need to see what they're doing, because sometimes for one thing, the textbook is going to possibly question us about this on the test, but also in real life, if manual systems are still in place and they're still using these periodic adjustments, then they would need to know these. So we're rolling with it. Okay. Then the next thing that happened was the supplies expense. Debiting supplies expense and crediting supplies. This was that toggle where we're shifting. We counted up the inventory and now we see that, oh, we don't have the right amount in our inventory account. We have to adjust it to correct. And the way we do that is with its little partner account. Supplies expense took a debit of 5170. Because all the supplies cost are either going to be in supplies expense or in the asset account supplies. Once you count and you see, oh, wait, we don't have $8,800 worth of supplies in there. We only have $3,630. That means the adjustment has to be made to shift the remainder that's not there in the closet anymore for supplies, shift that to supplies expense. And that's what they did with this entry. All right, the next one, insurance expense and prepaid insurance. Insurance expense takes a debit of $1,760, and its partner account is the only one that would be associated with it. There's not going to be some, oh, that's a surprise account connected to insurance expense. It's insurance and prepaid insurance, and it was for $1,760. Debiting insurance expense, $1,760. Crediting prepaid insurance, $1,760. You see where it arose. They looked at their insurance. They tallied up. Okay, how much of the insurance is still outstanding? It's not expired at the end of the period. And they said, oh, it's $4,180. Wait a minute. Our books are showing $5,940 for prepaid. We better adjust it to correct. So it's not $5,940. It's $4,180. So we need to credit prepaid $1,760 to get it down to the actual amount that's still not expired. And the part that had expired needs to be recorded as insurance expense. So that's why this entry is a debit to interest expense and a credit to prepaid, because we had to shift some of the insurance cost out of the prepaid into the now insurance expense, because when it expires, it becomes an expense of that period. All right, the next one, depreciation. Now this every year, you take a piece of the assets cost and you show it as an expense, and that's depreciation. $13,750. So debiting interest expense, this was the building, $13,750. Crediting accumulated depreciation, which is a contra asset, $13,750. That takes care of that entry. Now the next one is the equipment in depreciation, debiting depreciation expense on the equipment, crediting accumulated on the equipment. And the amount was $5,500. And you know how you can, if you want to put the zeros, you just put your decimal and then put your zeros. Depreciation expense store equipment, $5,500. You see how they know, for sure what it was? Because when you finish this entry, your adjusted balance is these numbers that we're talking about. So that's correct, because that's the only way you can get a $5,500 balance into that depreciation expense account. You have to debit it with your journal entry. Okay, so the store equipment, $5,500. Look how it changed the balance from $44,000 to $49,500. That's correct, isn't it? That looks right. So when you're done, even before you click check my work, you can look at every entry you have in the adjustments column and see if that posting that debit or credit or both will bring you to the ending balance in the adjusted trial balance. And if it does, you're right. Okay, so the next one after the equipment depreciation is a shift from between wages expense and wages payable. We record a wage expense that's not yet paid, and it's $38.50. So that's an accrual. We're accruing this expense even though it hasn't been paid yet. Wage expense, where's wage? Why don't they put them alphabetical for me? I don't know. $38.50. Yeah, it brought it from $137.5 up to $141,350. That looks good. Wage payable takes the credit of $38.50. Yep, that looks right. There was nothing in wage payable, and now there's $38.50 credit. This is good. The next entry is the rent. This was our unearned rent. And so we had an amount in unearned rent. Let's look at it. We had $9,790 in unearned rent. So at the end of the period, we would evaluate and see how much is still not earned. But over time, when the customer or the client uses the property, then their rent that they paid us in advance, it starts to have been expired, just like the insurance expires. So basically, they used up their rent for the month that they prepaid for in some, at least part of it. And so we shift from unearned rent, which is a credit balance account, so we're going to debit, over to rent revenue, which is a credit balance account. So we shifted the rent revenue is together there in the two accounts, unearned rent revenue and rent revenue. And so when we see that unearned rent revenue is holding the wrong amount, it's not still unearned, that month expired, that month passed. So we need to show that part as rent revenue. So that's the part that we're shifting, $4,840. We can't just make these numbers up, but the reason we know these are the correct numbers is because we're just recreating what they did in their trial balance. They made a debit to unearned rent revenue of $4,840. And we know that because we can see that their unearned rent revenue, which is liability account, so I got to find it here, went from $97.90 down to $49.50. So we know that they had an entry to reduce it, $48.40. It's a credit balance account, and that's why the debit was needed to do it. And then the rent revenue took the other part. Where did the rent revenue go? $48.40. And if you look, there was nothing in rent revenue, and now after our adjustment, there's $48.40. So that makes it all make sense. Now, you know what check will work, and you know there's a chance that I keyed something in wrong, or I touched the wrong account number with my finger, but I think I got it right. So let me try. Come on, check marks. So far, so good. Yeah, look at that. You see what I did? $20 right there. $24.20. It's going to happen to you, Tom. Possibly. Maybe not. Be good. Now I have to do it again, of course, because I want all the check marks. Yes, looks perfect. So this is a pain. You know this. I'm not saying it's not, but you can do it, and you need to do it so you can see what I'm talking about, that when you're making an adjustment at the end of the period, it doesn't just magically go from this was our trial balance to now here's our adjusted trial balance. No, everything about it was an adjustment that you made. And so they're wanting you to reconstruct the adjustments based on the fact that the trial balance numbers do not agree with adjusted trials. So obviously an adjustment was made, and they just want you to just pace through how to do it. The key to doing it without getting glitches is just go ahead and go in the same order I just went in, because that's what they're going to be expecting. And then you're less likely to get a glitch. Okay, thanks. You'll be good. You can do it.